Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session where we are going to discuss three very important finance current affairs, and the first one is also the RBI notification. Okay, so we are going to discuss about the RBI that has clarified regarding the voluntary gold silver collateral that is allowed for the small loans. So which are these small loans, which are the collateral free loans for the farmers or for the agriculture or for the micro and small enterprises. Okay, then we are going to discuss about the BSE that has launched the insurance index. What is the base for this, from which index this has been taken? So all of this we are going to discuss in today's session. So the facts are quite important in this BSE launches insurance index because this was quite in news recently. Okay, and the third one that we are going to discuss is that the SEBI has announced the settlement scheme for the VCF. So we will discuss about the VCF and then we will discuss about this settlement scheme for the VCF. Okay, so I hope I'm clearly audible and visible. Give me a thumbs up if everything is fine. So good morning everyone, welcome to the session. Good to see all of you here. Now let's start with the session. I hope I'm clearly audible and visible. Okay, so before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, so the PDF of the session you will get in the Telegram channel of EduTap, and the link for the Telegram channel is provided in the description box below. So let's get started with the first news article, that is voluntary pledge of gold and silver as collateral for the agriculture and micro and small enterprise loans. So basically what has happened, see, in December 2024, the RBI has said that the RBI has increased the collateral free agricultural loans, or the RBI has increased the limit for the collateral free agricultural loans. So keeping in view the overall inflation and rise in agriculture input cost over the years, so as the inflation is increasing and there is the increase in the input cost for the agriculture, that means the price of fertilizers, the price of pesticides, the price of seed is increasing. So the agriculture input cost is increasing. It has been decided to raise the limit for collateral free agricultural loans. Collateral free agricultural loans means in these kind of loans there is no requirement for the farmers to give any collateral. There is no requirement for the farmers to give any collateral. Usually when we want to take a loan, we have to keep something as girvi, right? We have to keep something as collateral. So in the case of the collateral free agricultural loans, there is no requirement to keep any collateral. These are the collateral free agricultural loans whose limit was increased from 1.6 lakh to rupees 2 lakh per borrower. Okay, so collateral free agricultural loans, they have the limit up to rupees 2 lakh per borrower. Accordingly, banks are advised to waive collateral security, to not take collateral security and margin requirements. There is no requirement of taking the margin requirements or the collateral security. Next is, in the case of micro and small enterprise sector, it was said that banks are mandated not to accept collateral security in case of loans up to 10 lakh rupees that is extended to units in the micro and small enterprises. So basically it is mandated that the banks cannot take any kind of collateral security in case of loans up to 10 lakh for the micro and small enterprises. And then for the different schemes that you must be studying under Gurkira sir, in different schemes there were different limits that were notified that you can read here. Okay, that here you can see that banks are also advised to extend the collateral free loans up to 10 lakh rupees to all units financed under the Prime Minister Employment Generation Program. Okay, banks may, on the basis of good track record and financial position of the micro and small enterprise units, increase the limit to dispense with the collateral requirement for loans up to 25 lakhs. So this was the basic requirement. So here you can see that for the agricultural loans up to the limit of 2 lakh, there is the collateral free loans that can be provided, and for the micro and small enterprises, the units in the micro and small enterprise category, they can get the collateral free loans up to the limit of 10 lakh. Okay, basically. So this is the idea. Now the RBI has said that if the micro and small enterprise wants, or if the farmers wants, they can provide the gold and silver as the voluntary pledge, as the voluntary collateral. That means these loans, these agricultural loans up to the limit of 2 lakh and the micro and small enterprise loan up to the limit of 10 lakh, they are collateral free loans where collateral is not required. But if the farmers want, if they have the gold and silver, if they want to keep it as pledge, or if they want to keep it as collateral, or let's say the micro and small enterprise wants to keep the collateral as gold and silver, they can keep it. Why do you think that you will want to give a collateral? Let's say I am taking a loan and it is a collateral free loan. So why would I want to give collateral? Because if you are giving the collateral, that is giving the security to the bank. If you are giving the collateral in the form of gold and silver, or gold or silver, if you are giving the collateral, that is giving the bank the security. That is giving the bank the security. In comparison to the collateral free loans, the banks are more secure in the when the collateral is given. Okay, so if the farmer is willing to give the collateral, or if the micro and small enterprise is willing to give the collateral, they are giving voluntary collateral. The bank is not asking, they are giving the collateral. So here the bank can have favorable terms and conditions for these farmers, for these micro and small enterprises, and the farmer can provide the loans at the lesser interest rate and such. Okay, because these are secure loans. Okay, so it is clarified that loans against the voluntary. So the farmers, the farmers and the micro and small enterprises, they can have the voluntary pledge of gold and silver as collateral by borrowers. So the banks can take the voluntary collateral that is given by the farmers or by the micro and small enterprise. So this is the idea, sanctioned by the banks. So if the loans are getting sanctioned by the banks, the farmers, the micro and small enterprise, they can give voluntary pledge of gold and silver. It is not compulsory, it is voluntary. Okay, up to the collateral free limit as covered under the following guidelines. Any confusion here, anyone? So this was it. Any confusion in this case? Clear? Now, this is the first news article, that actually the collateral is not required till the limits, but if the farmer or if the micro and small enterprise want, they can provide the voluntary gold and silver collateral, and if they are providing the collateral, of course they will get better terms and conditions because the banks are getting the security. Okay, this is the idea. Next news article is regarding the BSE launches insurance index to track sector performance. So actually it is the wholly owned subsidiary of the BSE that has launched this BSE insurance index. Okay, so BSE through its wholly owned subsidiary, that is Asia Index Private Limited. So remember this name, that is Asia Index Private Limited, because in the news articles you will hear the term BSE, but it is actually the Asia Index Private Limited, a wholly owned subsidiary of the BSE, that has launched this BSE Insurance Index, that has unveiled a new sectoral benchmark, the BSE Insurance Index, offering investors and fund managers a focused tool to track the performance of the listed insurance companies in India. Okay, so the index, like we have the bank index, okay, we have the bank index and such. So Nifty 50 index, Nifty 100 index, or BSE 1000 index, or the BSE all cap index is there. So there are the indexes against which the passive fund managers, like you must have heard about the active fund managers and the passive fund managers. So passive fund managers, they just track the indexes, the important indexes, top 100 companies, top 50 companies and such, or the top banking companies and such, or top IT companies. So the passive fund managers, they just track the index and they invest in the shares of the companies that are in the index. Okay, so passive fund managers, they just start investing in the companies, in the shares of the companies that are in the index, and in the same weight as the companies are in the index. Okay, so passive fund manager, they follow the index, or they follow a particular index. Let's say passive fund managers have decided to follow the Nifty 50 index or the banking index, so they are following a index and they are doing the investment as per that. Then there are the active fund managers. Active fund managers, they do not thoroughly follow a index, but they have this index as the benchmark criteria, that okay, they have to perform better than this particular index, or they also look into this index so that they have the clarity that where they are investing, or are they able to get more profits than the index or not. Okay, so active fund manager, they invest according to their understanding, according to their research that they have done, but they also have this benchmark, that is the index. Okay, so now it has been said that the BSE Insurance Index has been launched by the Asia Index Private Limited to provide the investors and the fund manager a focused tool to track the performance of the India's listed insurance companies. Like we have an index for the banking companies, similarly now we have an index for the insurance companies. This is the idea. The index, now the basic idea about the index, or the facts about the index. So you do not have to go too much in depth, but you must know some facts about this index. Okay, any confusion? Okay, the the index draws its constituents from the BSE. So basically what happens that there is a BSE 1000 index. Okay, the BSE 1000 index, it consists of 1000 top companies in the basis of the performance. So BSE 1000 index, the index measures the performance of 1000 of the largest and most liquid Indian companies within BSE all cap. All cap means large companies, medium companies and such. So in all the cap, in all the market capitalization, that is all the companies that are present in the BSE. So BSE 1000 index, it consists of the 1000 largest and most liquid Indian companies. So from the BSE 1000 index that consists of the largest and most liquid companies, the BSE insurance index is constituted. Okay, so from the BSE 1000 index, the BSE insurance index is constituted. So in the BSE 1000 index, whichever insurance companies are there, so these insurance companies, they are taken for the BSE insurance index. So basically the index, the BSE insurance index, it draws its constituents, it draws its companies, we can say. So the companies that will come under the BSE insurance index, they are from the BSE 1000 index, including only those stocks classified under the insurance industry. So basically the BSE 1000 index, it consists of top 1000 companies. Out of those top 1000 companies, which are the insurance companies, so they are segregated and they are brought under the BSE insurance index. That is the idea. Okay, now the index is weighted. Now this BSE insurance index, it is weighted on free float. Free float means that the shares that are actually traded in the market. Okay, so market capitalization means the share value or the price of the share multiplied by, here we are seeing the free float market capitalization. Basically, if we want to see the shares that are getting traded, the shares that are actually getting traded, they are not held by the promoters, they are not held by the government, because those kind of shares are not getting traded. Let's say 20% of the shares are held by the promoters, they are just held, they are not getting traded. 10% of the shares are held by the government, so government is just holding it, government is not going to trade into it, right? So free float market capitalization means that the market capitalization, the share value we are seeing, and multiplied by the share number of shares that are actually getting traded. Okay, so that is free float market capitalization. So market capitalization basically means the share value multiplied by the total number of shares. This is market capitalization. But when we talk about the free float market capitalization, here we want to see the share value or the price of the share multiplied by the number of shares that are actually getting traded in the market. So this is the free float market capitalization. Okay, so now in BSE insurance index, which company is the big company, which company is the small company? So if we want to see that, we have to take the index is weighted. Okay, the big companies are provided with more weightage, the small companies are provided with lesser weightage. So index is weighted on free float adjusted market cap. That means if the free float adjusted market cap is high for a company, that company has more weightage. Okay, so if a company has free float market capitalization higher, that company will have higher weightage in the index. Any confusion in this? That is what is free float market capitalization and what is the way that the index is seen or index is weighted. Any confusion here? All clear? No. Okay, nice. So this is the idea, free float market capitalization. So the index is weighted, or all the companies in the index, they are weighted on the free float market capitalization, and individual stock weight is capped at 25% or around 25% to ensure that diversified exposure and prevent concentration risk, so that there is diversified exposure and one single company is not getting more than 25%, or like a single company is not getting 50 or 100% of the weight. Okay, this is the idea. Next point is that the index is launched with the base. So the index, that is the BSE insurance index, it is launched with a base value of 1000. The index is backdated to start from 18 June 2018. So it is backdated to start from 18 June 2018. It currently comprises 12 insurance companies and is set to be reconstituted semi-annually. That means it will be seen again and again, semi-annual basis. The index will be reconstituted. The companies will be seen that, okay, which company has grown, which company should get more weightage and such. So on the Okay, sorry, the camera was fluctuating a little. So index at a glance, so BSE Insurance Index is designed to measure the performance of all the companies classified under the insurance industry. The index comprises constituents categorized as insurance. Basically, the insurance companies are under the index. Basically, the insurance companies are under the index, okay? So this is the idea. So index comprises constituents categorized as insurance. So the index consist of the insurance companies or the constituents that are in the insurance industry. This is the idea. Launch date 10th July 2025. So it is launched in July 2025 and the first value date is 18 June 2018. The base value is 1000. So remember that the index base value is 1000. If the value of the index goes up to 1500 or 2000 or 3000, that means the index is growing. That means the insurance companies are growing rapidly. That is the idea. Number of constituents, that means number of insurance companies in the index, so that is 12. The reconstitution frequency is semi-annually in June and December. And the weighing method, that means the companies are weighed. The SDFC Life Insurance Company has the weight of 25.19%. SBI Life Insurance Company has the weight of 23.81%. So the company is weighted on the basis of the float, the free float adjusted market capitalization that we have discussed. Index universe, so the index, the BSE Insurance Index is taken from the BSE 1000 index, okay? This is the basic idea. Now here you can see that the top 10 constituents by weightage. So basically the SDFC Life Insurance Company Limited has the highest of the weightage, has the highest of the weight, okay? So this is the idea that the SDFC, some of the top weighted stocks in the index include SDFC Life Insurance Company Limited, SBI Life Insurance Company Limited, ICICI Lombard General Insurance Company Limited. So you do not have to remember the percentages or the weight, but at least try to remember the top three, that is SDFC first, then SBI, then ICICI, okay? This is the idea. Now coming to the last news article, that is the SEBI has announced settlement scheme. Any confusion, anyone? Are you able to see the fluctuation that is happening here? No, right? Okay, so SEBI has announced a settlement scheme for the VCF, that is the venture capital fund. So SEBI board, that is the Securities and Exchange Board of India's board of directors, they noted the decision to introduce a one-time, this is a one-time settlement scheme for the venture capital funds. The scheme provides a settlement opportunity to VCFs who have completed the migration. So basically, let's understand the background, then you will be able to understand this better. So first of all, what are the VCFs? VCFs are the venture capital funds. They are investment instruments through which individuals can park their money in newly formed startups. So basically VCFs, they are the venture capital funds. They are the funds that collect the money from the investors and they invest the money in the startup companies, in the medium and small enterprises, okay? So this is the basic idea, that the venture capital funds, they collect the money from the investors. They collect the money from the investors and then these venture capital funds invest this money into the different schemes, into the different startups, into the different small and medium-sized companies. These are the types of investment funds that primarily target firms that have the potential to deliver high returns, because the startups or the small and medium enterprises, they have the potential to provide more returns because they are just growing, they are in the growing phase, and once they keep on growing and growing and growing, their profits also keep on growing, okay? So the investment fund, these investment funds invest in small companies or the startups and the small and medium enterprises that have the potential to deliver high returns, but with high returns come high risk also. So these venture capital funds, they have considerable risk also. So investing in these companies also involves considerable risk. Now what has happened, see, try to understand that in 1996 for the VCFs, there were the guidelines that were formed in 1996. Now what happened, that these guidelines, they were on the basis of the initial phases of the venture capital funds, and at that time the guidelines were not very prudent, and with the changing market conditions, with the evolving financial markets, it was realized that these guidelines that were released in 1996, they are not very prudent and they are not very extensive. So that's why the alternative investment fund guidelines were released in 2012 and different kind of investment funds were under the alternative investment fund, okay? So there was category 1, category 2, category 3, Okay, so in the category 1, there were venture capital funds, there were social infrastructure funds and such and such. In the category 2, there were real estate funds. In the category 3, there were different kind of hedge funds or the private equity funds and such. Okay, so basically the alternative investment fund guidelines for regulations were brought in 2012. So upon notification of Securities and Exchange Board of India Alternative Investment Regulations 2012 that was released in May 2012, the Securities and Exchange Board of India Venture Capital Fund Regulations 1996 were repealed. So basically it was said that in the category 1 of the alternative investment fund, we will have the venture capital funds. So the new venture capital funds that will originate after 2012, they will be registered under the alternative investment fund category 1. So it was said that now this guideline will be followed by the investment funds. Basically these guidelines will be followed, that were the new prudent guidelines, and we have repealed the 1996 guidelines. But it was said that the venture capital funds that were already established as per these guidelines, they can complete their tenure under these guidelines. Okay, so venture capital funds registered under the VCF regulations continue to be regulated under the repealed VCF regulations till their scheme tenure ends, till the tenure of their fund ends, till the tenure of their scheme ends. Let's say the tenure of the scheme was 10 years or 12 years. So till the tenure of their scheme ends, till then they can continue with this under this VCF regulations. Okay, so this was the basic idea that the AIF regulations came in 2012 that repealed the VCF regulations of 1996, but it was said that the VCF that have initiated their schemes, that have initiated their fund under the previous guidelines, they can continue under the previous guidelines until their existing funds or schemes are wound up or they are finished. Or their life cycle finishes, the scheme's life cycle finishes. That means multiple investors have invested in the VCF, and let's say the different schemes have the different time period, 5 years, 10 years, 12 years, 8 years. Okay, some of the schemes might have ended, but some of the schemes are still running. So it was said that till the scheme ends or till this fund ends, till then the VCFs, the older VCFs, they can work under the older regulations. But some VCFs are unable to liquidate their investment during the tenure of the fund. So tenure of the fund, let's say the 10 and 12 years have passed and still they are unable to liquidate their fund. That means they are unable to repay the investors in whole. So some VCFs are unable to liquidate their investment during the tenure of the fund and continue to hold the unliquidated investment. That means they continue to hold the money of the investors, the unliquidated investment. It might be because the investment is illiquid. The startups or unlisted companies, they have no active secondary market for trading, because these startups, these unlisted companies, they are not listed in the trade exchanges. So the venture capital fund has no way to sell the portion that they have. Okay, so these are the illiquid investment, because the startups or the unlisted companies, they have no active secondary market. And now if the VCF wants to sell its share, then it has to find a buyer in the illiquid market, and it is very hard to find another buyer. Okay, adverse market condition, economic downturn has come, due to which the startup that was thinking of launching its initial public offering has not been able to launch its IPO. So economic downturn delays the IPO or reduce the acquisition opportunities. Legal or regulatory challenges are coming. That means the portfolio companies or the venture capital funds may be stuck in litigation, and the portfolio companies in which the VCF has invested. So these portfolio companies, these startups or small and medium enterprises, they may be stuck in litigation or insolvency. Okay, or strategic delays are being done by the fund managers because they find that in the future they might get better deals. So any of these reasons are there, any of these reasons can be there, and due to this, the venture capital funds have unliquidated investment that has not been liquidated. So basically the investors invested in the venture capital fund. Let's say the venture capital fund had the scheme of 10 years. This was launched in 1998, so till 2012, or this was launched in, let's say, 2010. So this scheme was of 10 years and such, so it had to continue till 2020. Okay, the scheme had to continue till 2020, and till like 2020 has come, but still the fund has not closed. Okay, so the venture capital fund launched a scheme in 2010, where the venture capital fund said that we are going to invest in certain startups, we are going to invest in certain small and medium enterprises, and this investment will be for 10 years. After that, we will release our investments and we will finish our investments and we will repay the investors. Okay, so investors invested in this venture capital fund in 2010 and assumed that they will get back their money by 2020, and they will also get the returns from the startup and the small and medium enterprises. Now the 10 years have passed, 2020 has also passed, but still the funds have not been liquidated. The investors have not got their money back, the complete money back basically. Okay, so some VCFs are unable to liquidate their investments. It might be because of the market conditions, or it might be because the fund managers are assuming that in the future they might get better deals. So any of the reasons can happen, due to which there are still unliquidated investments that are still kept with the VCFs. So the SEBI issued a circular on August 19, 2024 introducing a migration framework. So SEBI said, first of all, these VCFs that have unliquidated investments, that have not returned the money of the investors, first of all, they have to convert from the previous directions to the new directions, so that the SEBI can take better regulations, or SEBI can take better measures for these VCFs. Okay, so SEBI issued a circular on August 19, 2024 introducing a migration framework for the VCFs operating under the repealed regulations. So it was said that the VCFs that are still working under the repealed regulations, they have to convert, they have to migrate to the alternative investment fund, the new regulations basically. The framework allows such VCFs. So this circular, this allows such VCFs transition into the AIF regime of 2012 under a new subcategory called migrated VCFs. So these VCFs that have unliquidated investments, they have to convert from the VCF regulations to the AIF regulations, and these VCFs are known as migrated VCFs. These VCFs are known as migrated VCFs. Eligibility for migration is that these VCFs with schemes whose liquidation period has not expired, maybe there are certain schemes whose liquidation period is, let's say, 2026, or whose liquidation period is 2025, let's say. So their liquidation period has not expired. So these VCFs with schemes whose liquidation period has not expired, they have to convert from the VCF regulations to the AIF regulations, as well as the VCFs whose schemes have expired but they have unliquidated investments. So these VCFs have also to convert from the previous regulations to the new regulations. So this was said in 2024. Any confusion here? Any confusion? So basically there are certain VCFs whose scheme has not expired, and there are certain VCFs whose schemes have expired but they have unliquidated investment, they have not returned the complete money of the investors. Okay, so these VCFs whose schemes have not expired, or whose schemes have expired but they have unliquidated investment, they have to convert. It was said in 2024 that they have to convert from the previous regulations to the new regulations. Okay, now the scheme, a new scheme has been brought. So this was said in 2024, and this, I guess we have discussed this in May notification or May finance current affairs. Okay, now what has happened, that the VCF settlement scheme 2025 has been brought by the SEBI. So recently SEBI has released the VCF settlement scheme 2025 that provides a settlement opportunity, because if the VCFs have unliquidated investment, so they are being fined by the SEBI, or SEBI is saying that, okay, we are going to take actions against you because you have not returned the money of the investors within the set time frame. That is wrong. You should have returned the money of the investors. So the VCFs that have unliquidated investment, that have not liquidated their investment during the tenure of the fund, so SEBI is going to take action against them. SEBI said, we are going to take action against you because you didn't finish your schemes in the given time frame. So now this SEBI said that we are going to take action against you. The VCF said, okay, we had good reasons to not liquidate because of the market conditions, because of this and that, we were not able to liquidate. So SEBI is saying that, okay, we are bringing one-time settlement scheme for you, under which you just have to pay certain fines, and the SEBI will not take stringent actions against you. You just have to pay certain fines. So this is the VCF settlement scheme 2025. This provides a settlement opportunity to the VCFs who have completed the migration, first of all, to the new regulations. The scheme has been proposed to provide an opportunity to such VCFs to settle, to such VCFs that have unliquidated investment, to settle actions arising out of having schemes whose liquidation period have expired, but they have not returned the complete money to the investors. So basically, SEBI was going to take action against the VCFs. So SEBI was going to take action against the VCFs whose schemes had expired, but they still had unliquidated investment. So SEBI was going to take action against them, but now SEBI has said that let's do a one-time settlement scheme so that it is less burden on the SEBI also and less burden on the VCFs also. Just a sec. Okay. Are you able to see the screen clearly? I'm like, I don't know how. For me, it is blackout that is happening. Just a second. I think it will work now. Okay. So basically, SEBI had to take actions against the VCFs whose tenure has expired, but they have not liquidated the investment. They have unliquidated investment that is still left, and these VCFs should have converted from their VCF regulations to the AIF regulations. For these kind of VCFs, the SEBI has released the settlement scheme. Okay, so the eligibility criteria for the settlement scheme is that the VCFs have at least one scheme whose tenure has expired, but they have not liquidated the investments. They have unliquidated investment and has completed the migration to the AIF regulations. Okay, because under the AIF regulations, they should be. Validity of the scheme. So the scheme shall commence on July 21, 2025. So basically, if you want the pardon from SEBI, if you want SEBI to not take actions against you, you have to be in the scheme. Otherwise, SEBI will take actions, as easy as that. Okay. The scheme shall commence on July 21, 2025 and end on January 19, 2026, both days inclusive, or such other date as approved by the competent authority. But for now, the deadline is this, that the scheme will commence on July 21, 2025 and end on January 19, 2026. So if you want pardon from the SEBI, join the scheme. Okay. Settlement application. So an entity desirous of making an application for availing settlement under the VCF settlement scheme 2025 shall be advised to submit a settlement application along with a non-refundable application fee of 25,000 plus applicable GST of 18% in the specified format as given by SEBI. Next is terms of settlement of the scheme. So what are the terms of settlement? How much fine has to be paid? So base amount for settlement for delay up to 1 year in winding up the scheme. So the base amount for settlement for delay up to. So if the delay has happened up to 1 year in winding up the scheme, then there shall be the base amount of settlement fee of 1 lakh rupees. Okay, for every subsequent year of delay or part thereof, an additional amount of 50,000 shall be applicable. So basically, if the delay has happened by 1 year, that means you have done the payment delay, or you have done the the investments have been liquidated with a delay of 1 year. So then the base amount for settlement is 1 lakh. But if the delay has happened of in the second year also the delay has happened, so then the first year 1 lakh rupees, second year 50,000, third year 50,000, fourth year 50,000. So for every subsequent year of delay, there will be 50,000 that will be payable additional amount. Additionally, the following amounts are required to be paid. Additionally, these are the amounts that are to be paid for holding unliquidated investments of investors beyond the tenure of the fund or scheme. So if up to 25 crore is the cumulative unliquidated investment as on date of application for migration to the AIF scheme or to the AIF regulations. So if the unliquidated investment is up to 25 crore, additional 1 lakh rupees has to be paid. If the cumulative unliquidated investment is more than 25 crore but less than 50 crore, 2 lakhs have to be paid. More than 50 crores, less than 100 crores of unliquidated investment that is not paid back to the investors, then the fine will be 4 lakh, and so on and so forth. You can see that if more than 200 crore of unliquidated investment is present with the VCF, then the fine, additional fine has to be paid of 6 lakh rupees. Okay, so this is the idea, that if the cumulative unliquidated investments are present, so the additional amounts or fines have to be paid to the SEBI. Okay, this is the idea. So the following amounts are required to be paid for holding unliquidated investment for investors. Now, prior to applying under the settlement scheme, VCF should have completed the migration or their conversion from the VCF regulations to the AIF regulations. This is the basic idea. The settlement amount and all expenses related to settlement shall be borne by the investment manager or sponsor and shall not be recoverable from the scheme, fund or investors. That means the money has not to be taken from the investors. It is not the mistake of investors. So the fund managers or the sponsor investment managers have to bond the bond. Okay. The last date for applying under the settlement scheme shall be 6 months from July 19, 2025, that is January 19, 2026, or any other date as may be notified by SEBI. So this is the idea. Now, upon expiry of the last date of migration, see, if the VCF wants to migrate to AIF, the last date for migration was July 19, 2025, because the migration was announced in August 2024 itself. The migration was announced in August 2024 itself. Here you can see that in August 2024, it was said that the migration has to happen from VCF regulations to the AIF regulations. This settlement scheme is introduced in July 2025 in recent month, but the migration was announced in 2024. So migration should be finished by July 19, 2025. So upon expiry of the date of migration, that is July 19, 2025, SEBI may initiate action against such VCFs that have schemes whose liquidation. So basically, it is said that if the VCF has unliquidated investment after the scheme tenure has finished, then the VCF, if it has converted to the AIF regime, will get the settlement scheme, will get the relaxation under the settlement scheme if the VCF adopts for that. But let's say the VCF has unliquidated investment for the scheme whose tenure has finished and the VCF has not migrated to AIF. So the settlement scheme is not applicable on this VCF. So the SEBI will take action as per the SEBI regulations. This is the idea. So upon expiry of the last date of migration, that means if the VCF has not migrated till this date to the AIF regime, then the VCF is not allowed for the settlement scheme because the migration has not happened to the AIF regime. So SEBI may initiate action against such VCFs that have schemes whose liquidation period has expired, whose scheme tenure has finished, but now not wound up or not have liquidated the investment, that continue to hold the unliquidated investments and have not availed the opportunity under the VCF settlement scheme. Basically, this is the idea. Okay, any confusion here, anyone? No, you don't have to remember the table. Just remember that the amount, additional amount, is up from 1 lakh to 6 lakh and it is divided into different categories. Okay. Any confusion, anyone? Okay, so this is the first question. I hope you will be easily able to answer this question. You just have to tell that for the agricultural loans and including loans for allied activities, up to what limit is the collateral free loans. Okay, this is the second question. So now, before showing you the second question or before discussing the second question, let me tell you that there is a perspective 360-degree series where Jaskan sir takes the session, and this is the perspective 360-degree series that happens on Monday, Wednesday and Friday at 5 p.m. where you can join the sessions and you can know the art of writing the answers. Here the current topics are taken on which the descriptive questions are given, on which you have to write the answers. Okay, so this is the basic idea, and this happens on Monday, Wednesday and Friday at 5 p.m. and every session a question is given for you as the homework question that you can write in the comment section below, and the answers are also getting evaluated if you answer within 48 hours. Okay, so this is very good for your answer writing practice if you are going to give NABARD, RBI. So this is very good for your answer writing practice and for you to know current topics from which the descriptive questions can come. Now this is the second question. Here you have to tell that which of the following statement is correct in regards to the BSc insurance index. Now coming to the third question, here you have to tell the statement that is incorrect in regards to the settlement scheme. Okay, so this is the third question. So this is it for today. Thank you very much for joining the session. Is there any confusion anyone has? Is there any confusion, anyone? All fine? All good? Okay, so do give the right answers in the homework, do give the right answers of the homework question in the